It's a great pleasure for me to be able to introduce to you my former colleague, Dan Tarullo. You have his biography and the materials you have. I'll highlight, well, one important thing. Like the other person on this podium, he did his graduate work at the University of Michigan, so you know he's a man of good taste. He has combined distinguished careers in law and public service. He's been on the faculties of Georgetown and Harvard in the law area. He served in several different positions in economic policy in the Clinton administration. He joined the Board of Governors in January 2009, just in time for the turnaround. Good work, Dan. I think the most important thing to note is he has led the board's efforts in regulatory and supervisory area, its response to the crisis and the implementation of Dodd-Frank. In doing that, he's delivered a number of thoughtful and thought-provoking speeches and testimonies on bank structure and regulation, explaining the issues, the responses of the government and the Federal Reserve, and defining the potential way forward. So, Dan, we are looking forward to today's address to add to that list of speeches. Thank you.
Thanks, Don. Oops. Thank you, Don. And it is a pleasure to be here at Brookings this morning. I'm really glad that Don and Doug and Martin have set up this forum on the industrial organization of the financial industry, because as Don alluded to a moment ago, it's important not just to keep focusing on the policies we've got and the policy proposals that are currently being debated, but also to continue, and I would say to some degree reorient the stream of research that provides the foundation for evaluating those policies and also developing new ones. As I've suggested previously, when one considers the significance of issues concerning industry structure for the design of an effective and efficient regulatory system to contain systemic risk, it is surprising that relatively little research has been undertaken in this area, even in the aftermath of the crisis. Now, of course, good empirical research does take time, and that's why I welcome the opportunity to contribute to a discussion of an agenda for research on industry structure. So what I'll do is to begin by explaining briefly why this agenda, from my perspective, is both important and somewhat challenging. And then I'm going to turn to one issue of particular significance, that of scale and scope economies, especially as they relate to policy proposals directed at the too big to fail problem in financial markets. The value of an I/O research agenda for shaping a regulatory system to protect financial stability lies both in ascertaining costs that may result from specific regulatory measures and in revealing industry dynamics that may suggest how regulatory measures can be more effective. The importance of understanding the costs of various regulatory measures is self-evident. As I will discuss shortly, I/O can help determine the circumstances in which firm size or industry concentration is associated with economies of scope and scale that carry social benefits. Any reduction in such benefits would be an unintended cost of financial stability policies. Conversely, though, if firm size or industry concentration is found to stem only from market power or from funding advantages associated with too big to fail policies or perceptions, then some policies aimed at diminishing systemic risk would have the added benefit of mitigating market failures. Less obvious, perhaps, than the isolation of costs associated with regulatory initiatives is the potential for I/O research to inform financial stability regulation by illuminating industry dynamics that may not be intuitively apparent. For example, unlike firms in most other industries, large financial institutions transact with one another on a nearly continuous basis and regularly maintain contractual relationships carrying substantial future obligations. The daily operations of most firms in the financial industry depend to a much greater extent on the conditions of their competitors than do operations of firms in other industries. By extending work on patterns of cooperation and competition among firms in other industries to the financial sector, I/O might help shape regulatory structures that can reduce the potential for contagion during periods of financial stress. As important as I/O research can be in developing financial regulation, the financial sector is in key respects sufficiently different from other industries as to limit the relevance of at least some existing research. In addition to the just noted contractual interconnectedness of competing firms, the combination of correlated asset holdings, maturity transformation, and mark-to-market accounting means that distress at one firm leading to asset fire sales can create problems at competing firms. Finally, the presence of systemic risk in financial sector intermediation adds an important consideration not normally present in I/O analysis of other industries. Thus, as noted earlier, too big to fail problems can affect the analysis. In addition, prudential regulation can create opportunities for arbitrage both among products and practices in the regulated sector and between the regulated and unregulated sectors. Although the characteristics of the financial sector may thus limit the relevance of conclusions from I/O research in other sectors, they do not limit the relevance of the questions about industry structure and relationships asked by I/O economists. They argue instead for combining the I/O approach with the specialized learning of finance, a part of economics that has grown so important precisely because of the manifold ways in which the financial sector differs from other industries. There are a few topics within I/O more familiar than that of scale and scope economies. And there are a few reform proposals that have been put forward more regularly since the start of the financial crisis than those to limit in some manner the scale or scope of financial firms. Notwithstanding the coincidence of these two facts, though, there's relatively little academic research on scale and scope economies in the financial sector, and almost none pertinent to the operations of large financial conglomerates. The sources of scale and scope economies in the financial sector are generally similar to those found in other industries. Cost-reducing scale economies are available in areas where fixed costs are reasonably high, such as in information technology and other infrastructure systems. Network effect economies are seen in the large distribution networks that allow security dealers to offer clients wider sources of funds for issues of debt and equity instruments. Broad geographic reach allows firms to offer integrated global payments, collection, or other services to internationally active clients. There may be scope economies for banks and their customers when a variety of services is provided, thereby reducing information and other transaction costs. A range of relevant economies can be illustrated with a simple example. So a firm engaged in merger and acquisitions advisory work needs to assemble a team with many areas of expertise. A scale economy may be available because the average cost of advising on a single transaction will be lower if the firm is involved in more transactions, thus fully employing the team and facilitating greater spillovers of sector-specific information across transactions. By providing financing for the transaction, the firm may also be able to achieve a scope economy because its financing activities can leverage off the information developed by the merger and acquisition advisors, thereby reducing due diligence costs. Moreover, a client's own transactions costs may be lowered when the firm is able to provide most or all of the financing because its balance sheet is large enough to fund the acquisition without breaching applicable internal or regulatory lending limits. Similarly, a client may lower its transactions costs by using a single firm for both advising and financing. The paucity of empirical work means we can only hypothesize these scale and scope economies, though intuition and observation may make some hypotheses stronger than others. Even assuming, as I think reasonable, that most or all of the economies I have identified would hold up to empirical assessment, the crucial questions would remain as to how big or how integrated financial firms need to be in order to attain these economies. The relative dearth of work that would help answer these questions can be attributed to a number of factors. First, the sample size of the very largest firms is so obviously small, limiting the ability of researchers to derive precise statistical relationships between cost on the one hand and firm scale and scope on the other. This problem of sample size is exacerbated by the fact that there has been tremendous growth in the size, complexity, and concentration of the financial sector over the past 15 years or so. Second, there are serious limitations on the data available to researchers, and thus any useful discussion of an analytic agenda for research on financial industry structure must include an agenda for overcoming proprietary and other constraints on developing appropriate data sources. For example, data on the use of a variety of financial services by specific customers is generally unavailable to researchers. Third, even if appropriate data becomes available, it may be quite difficult to isolate costs for particular banking activities, given the number of products and activities offered by even moderately complex financial institutions. Two additional considerations bear mentioning in mapping out the issues associated with scale and scope economies in the financial sector. The first is a well-known qualification to the proposition that scale and scope can be beneficial, the possibility that firms may grow so large as to face diseconomies of scope and scale. Although existing empirical work is again scant, one often hears the suggestion that complexity and agency problems may lead to diseconomies for financial firms under certain circumstances, a proposition that should be considered alongside the hypotheses for positive scale and scope effects. The second point is that the size and composition of a financial firm's balance sheet play a complicated role in producing economies of scope and scale. To be sure, a large trading book or custody business might produce social benefits by allowing a bank to match or clear both sides of transactions at lower cost. And large balance sheets would appear to enable banks to diversify or hedge their positions and to access a variety of funding sources, thereby reducing their cost of capital. But conventional IO-type analysis, which would tend to interpret lower funding costs as evidence of scale economies, is potentially misleading in the financial sector. Consider in this regard my observation of a moment ago that a large balance sheet may reduce a bank's cost of capital. If lower funding costs do result from the diversification of risks and funding sources made possible by a large balance sheet, they would indeed suggest the existence of scale economies. But they may also result from the belief of some counterparties that a firm with a very large balance sheet is too big to fail, and thus at least some liabilities of that firm will be backed by the government in a time of financial stress. In this instance, lower funding costs actually suggest a market failure induced by the distortion arising from the implicit government guarantee. In practice, both scale economies and market failure may play a role. Although the potential moral hazard associated with too big to fail funding is a significant issue, it is also reasonably discrete and susceptible to countervailing policy measures such as capital requirements and credible resolution mechanisms. But some strands of finance research suggest more profound implications for certain configurations of financial industry structure. For example, numerous papers suggest that the very large balance sheets of very large financial firms tend to be highly correlated, such that a shock to certain asset classes is likely to reverberate quickly on the balance sheets of most large firms, as fire sales and subsequent mark-to-market effects affect even stronger firms. If this conclusion is valid, then the apparent economies associated with very large balance sheets may be transitory, or, more precisely, contingent on the absence of serious shocks to certain asset classes. It is precisely at this intersection between questions of industry structure and of the behavior of financial markets that a joint venture between IO and finance is most important. As I noted earlier, such an effort could not only help fill out an assessment of the social benefits associated with the size and industry structure of financial firms, but it could also lend insight into the kinds of measures that may be most effective in containing systemic risk. To illustrate more concretely how analysis of scope and scale economies is relevant to the development of a regulatory system designed to safeguard financial stability, I want to turn now to three proposals that are currently being debated fairly widely in policy circles. First is to break up large financial institutions by reinstating Glass-Steagall restrictions or by imposing other prohibitions on affiliations of commercial banks with certain business lines. Second are the proposals to place a cap on the non-deposit liabilities of financial institutions. And third, proposals to require financial institutions above a specified size to hold minimum amounts of long-term debt that would be available for conversion to equity to avoid or facilitate an orderly resolution of a troubled firm. So first, proposals to reimpose a Glass-Steagall prohibition on affiliations between commercial and investment banks have been met with the rejoinder that the origins of the financial crisis do not trace back very clearly to these affiliations. Many firms at the center of the crisis would have been essentially unchanged had Glass-Steagall been in effect. Bear Stearns, Lehman Brothers, and Merrill Lynch did not have sizable insured depository institutions, while Countrywide and Washington Mutual had few, if any, activities that could be termed investment banking. Wachovia did have a securities affiliate that was sizable, though hardly an industry leader, but its downfall seems pretty clearly connected to its exposure to subprime mortgages that it had written directly or acquired through mergers with other institutions. Proponents of breaking up firms along business lines may reply that the next financial crisis will not likely have the same genesis as the last, and that separating commercial from investment banking could at least mitigate the risks of extending the safety net provided depository institutions to underwriting, trading, and other activities of very large firms. But an IO perspective suggests that the proposal could also entail substantial costs. The reinstatement of Glass-Steagall would mean that bank clients could no longer retain one financial firm that would have the capacity to offer the whole range of financing options, from lines of credit all the way through to public equity offerings, depending on a particular client's needs and on market conditions. Moreover, many banks that are far too small ever to be considered too big to fail do provide some capital market services to their clients, often smaller businesses, a convenience and possible cost savings that would be lost under Glass-Steagall prohibitions. With the present state of research, it is virtually impossible to quantify the social benefit of these economies. However, what seems the likelihood of non-trivial benefits from current affiliations is a good reason to be cautious about adopting this proposal. Proposals to place a cap on a bank's non-deposit liabilities as a fraction of U.S. gross domestic product have been promoted as more directly responsive to the sources of systemic risk than are proposals to reinstate Glass-Steagall or to cap the total assets of a bank. Many studies of the financial crisis demonstrate that the reliance of large financial firms on non-deposit funding made them and the financial system as a whole susceptible to the dramatic runs that peaked in the fall of 2008. For the largest U.S. financial firms, non-deposit liabilities today are highly correlated with the systemic risk measures used at the Federal Reserve Board to measure interconnectedness and complexity for purposes of evaluating the financial stability effects of mergers. Another attraction of this form of proposal is that even as it places constraints on the potential size and composition of a firm's balance sheet, it allows relative flexibility to the firm in meeting that constraint, particularly when compared with proposals for prohibitions on commercial bank affiliations with other financial firms. A firm could shrink its balance sheet by shedding less profitable assets of its choosing. It could also shift its funding model more towards deposits, assuming, of course, it does not exceed applicable deposit caps. There are also ways to refine the proposal further, such as by weighting the non-deposit liabilities in the numerator of the ratio based on their duration. In short, as I've previously noted, there is considerable conceptual appeal in these proposals. Nonetheless, there are several important questions raised by the non-deposit cap idea. Foremost among these is the decision about the appropriate percentage of GDP that would constitute the cap. The determination of this limit would presumably be based on a number of considerations, including an evaluation of the capacity of the U.S. economy and financial system to absorb the losses resulting from the failure of a large firm. Several salient considerations are also suggested by a combined IO finance perspective. First, of course, is the key issue of how the functioning of funding markets is affected by the participation of very large counterparties using very large amounts of short-term wholesale funding, particularly under conditions of financial stress. This issue falls more on the finance rather than the IO side of the merged perspective. But it may be that aspects of industry structure, including some of the competition cooperation issues mentioned earlier, affect this analysis. Also, an IO finance perspective might identify possible alternatives to a non-deposit liability cap that achieve much the same financial stability goals at lower potential cost. Second is the question of scale and scope economies associated with non-deposit funding, the answer to which would help determine the limit at which significant social benefits might be lost, to be balanced against the avoidance of social costs arising from systemic events. Even with the flexibility noted earlier, a firm might have to sacrifice certain economies of scope or scale to meet a cap. If analysis finds scale and scope economies unlikely to be realized beyond a certain level of activity, then policymakers would have a point of reference for setting the cap. A third question is how second and third tier institutions might respond as the largest firms reposition and perhaps shed parts of their balance sheets. These institutions may well be purchasers of assets sold by the largest firms. They may also choose to take advantage of the lower demand and correspondingly lower prices for short-term funding by increasing their own short-term borrowing. Research might cast light on the extent to which various forms of a liability cap would affect market structure, the degree to which reduced activities by some firms would be taken up by others, and how such changes might affect the stability of the financial system. In sum, the IO finance perspective could contribute significantly to an elaboration and evaluation of this policy proposal. In the process, it could advance what I regard as the most important remaining task of financial regulatory reform, determining the most effective and efficient ways to deal with short-term funding markets, often characterized as the shadow banking system, that are inherently subject to runs. Proposals to require large financial firms to hold minimum levels of long-term debt are offered as a way to facilitate the orderly resolution of such firms. Variations on this general theme have gathered momentum as the Financial Stability Board, the Basel Committee on Banking Supervision, and other groups have explored ways to make large financial firms more readily resolvable, thereby giving national authorities a third choice between the unattractive options of bailout and disorderly failure. The basic idea is that the maintenance of minimum levels of long-term debt at the top holding company level will allow a resolving authority to transfer operating subsidiaries of the failed firm to a functioning bridge entity, while leaving behind in a receivership the equity and sufficient long-term debt to absorb the original firm's losses. Eventually, the resolving authority could recapitalize the bridge entity by exchanging claims of the long-term unsecured creditors of the parent for equity, for long-term debt of the bridge, or for both. In the United States, this approach is consonant with the FDIC's stated preference for a single-entry strategy in dealing with the resolution of systemically important firms under the orderly liquidation authority of the Dodd-Frank Act. But it is also consistent with variants on resolution mechanisms being implemented in other jurisdictions around the world. A minimum long-term debt requirement could lend greater confidence that the combination of equity owners and long-term debt holders would be sufficient to bear all losses at the firm, thereby counteracting the moral hazard associated with taxpayer bailouts while avoiding disorderly failures. To the degree the orderly resolution mechanisms established in the United States and elsewhere thus command greater credibility, the result should be enhanced market discipline, which in turn could enhance financial stability. As with the other two policy ideas, the details of a minimum long-term debt proposal matter when it comes to assessing costs and benefits. There will surely be some costs associated with such requirements, though it is notable that at present, large U.S. firms have substantial amounts of long-term debt on their balance sheets. Like a capital surcharge for the largest, most complex institutions, these costs will fall only on the largest institutions. But this is by design, in accordance with the principle reflected in the Dodd-Frank Act that the largest, most complex institutions should be subject to stricter regulation precisely because they are more complex and because their failure would have greater negative externalities for the financial system and the economy more generally. Thus, if there is a modest effect on industry structure, it would be an intended rather than unintended or undesirable consequence of the regulation. In general, then, at least at the levels of minimum long-term debt that are being discussed in various international fora, the proposal would not seem to carry significant hurdles to realizing available economies of scope and scale. My very brief review of these three proposals has tried to show how a combined IO finance perspective can contribute to the policymaking process and to what help identify what priorities for research might be. For the proposal to reenact Glass-Steagall, that perspective suggested the potential for considerable social costs. Application of the perspective to the proposal for a non-deposit liability cap revealed a number of important questions, an analysis of which could help determine the elements of such a proposal that would be most effective, identify costs, and possibly suggest alternative means to the same policy goals. In the case of the third proposal, for minimum long-term debt requirements, the perspective did not immediately suggest any unfavorable unintended consequences, thereby perhaps strengthening its appeal as a near-term policy measure. I have only grazed the surface of useful work that may spring from this hybrid subdiscipline. And as with the policy-relevant areas in which considerable work has already been done, we will never have all the analysis we might like before deciding whether to act, and if so, how. That is the condition that usually prevails in policymaking. But I am encouraged that Brookings has assembled this forum, which I hope will be the catalyst for much more academic activity in this area. Thank you very much. Okay, sit down. Okay.
Thank you, Dan. As I predicted, that was a thoughtful, thought-provoking speech with some hints of a way forward. So thank you for living up to my billing. Dan's agreed to answer some questions. One very important caveat is that he is in the blackout period for the Open Market Committee meeting next week. So the questions cannot bear on monetary policy in the macroeconomy. They'll have to stay focused on the subject at hand, strangely enough. So let me begin then. There's an awful lot going on in the regulatory sphere that is aimed at too big to fail, and also would have consequences for the industrial structure of the banking industry. You think about the capital requirements, liquidity requirements, Volcker rule, Collins, all kinds of things happening. And it's causing banks to reconsider what their business model should be. So there are big changes already underway. So I think I have two questions coming out of your speech. One is, by raising the possibility of the non-deposit cap, I inferred that maybe you didn't think the developments underway on too big to fail would be adequate to deal with the situation, to reduce the too big to fail subsidy and deal with that. And secondly, any thoughts you might have on separately about what's going on in the changing structure of the banking industry and how that might affect the competitive environment going forward.
Okay. Fair enough. So let me start with the second and then move back to the first. So I think, Don, there are probably three sets of factors that are affecting the evolution of industry structure, and it's probably a little more than a little hard to separate them right now. So one has surely got to be the evaluation by financial firms themselves of what they could have done better to avoid making themselves vulnerable to reverses in the market. And obviously one hears an enormous amount about changes in risk management and information systems and the like in financial firms, but that has obviously also affected how, for example, some firms fund themselves. And so I think we're going to continue to see an adaptation, and part of what we're probably already seeing is the realized responses. Secondly, and this veers a little bit up to the line on blackout, but I'll just say it and then move beyond it because it is a fact for industry structure. In an economy that's still not performing robustly, I think it's still a little unclear to people in the financial sector, as indeed to other sectors, what the new normal is going to be in terms of economic activity and the nature of markets and the like. And that's probably placing some constraints upon their ability to do medium-term strategic planning. And they're just having to wait to see what transpires. And third, of course, is the set of regulatory measures already in place or under consideration. And I would say that that I keep asking people in the industry and outside the industry what they think the financial sector is going to look like in 5 or 10 years. And I get, there are two kinds of responses that I tend to get. One is a confessed response of, we're not really that sure. A couple of things we're pretty sure are going to happen, not really sure within a broader range, so we're trying to be adaptive. And that suggests to me not committing enormous amounts of intellectual and actual capital to major changes. A second response is from some, no, we think we have a pretty good idea of a niche that will exist, but I'm struck by the niche notion, and that doesn't mean a niche meaning small. It means a place for a particular firm in what's thought to be the larger financial firmament. Those two kinds of responses, I think, are actually consistent with one another. Because if you think that you're the only guy anticipating that you're going to go into one niche, and it turns out that 3 other guys are going to conclude, hey, that's actually a pretty good niche, right, things may not turn out quite the way you had expected. So I think there's still a lot of understandable uncertainty, which is going to take a while to play out. We've got to be mindful of all of that in refocusing the regulatory system, but I think we both want to help shape certain features of it through the regulatory requirements, and this is where my short-term funding policy aim would come in, but also to recognize that you can't just keep waiting, because if you don't put your system in place now, you're going to create ongoing uncertainty for these people in financial firms who are trying to figure out what the environment, both economic and regulatory, is going to look like. On too big to fail, on the too big to fail point, the way that I have phrased it to myself for quite a while, and more recently, I guess, publicly, is I don't think too big to fail is a binary condition. That is, I don't think firms are either clearly too big to fail and perceived as such, or clearly not. I mean, I think it's, insofar as perception is important, which it surely is, people's perceptions differ, and there's surely a continuum. I think there is no question but that since 2009, the temporary equilibrium point has been pushed further along that continuum so as to mitigate the too big to fail problem. But I would certainly not say that it's been eliminated, and I don't know as a conceptual matter that one would ever want to say the problem has been eliminated. I think the policy aim has got to be to confine the problem substantially more than it obviously was in the years running up to the crisis. And that seems to me almost inevitably then, or inexorably, to call for a set of somewhat complementary policy measures which try to come at it in slightly different and, as I say, complementary ways. So that is how, for example, capital and resolution mechanisms, I think, are entirely consistent with one another. And as you can tell from what I said today, and I think what I've said in the past, the third leg of this, which I think still needs a lot of attention, is the funding question. The proposals for non-deposit liability caps, I think, are attractive vehicles for discussing the issues that remain, both too big to fail and funding, precisely because they combine both. And I think that the intuition behind the proposal is there in the financial system and a capacity beyond which we don't really think we can absorb the disruption at a major firm, and if so, what is it? That's an unanswered question, I think, but I think it's an important one. And for me, the most important thing in that Penn speech, whenever it was, in early October, and reiterating it now, is to try to promote this, the conversation which I think still needs to be prevailing, which is, how comfortable are we with how much we've pushed along the too big to fail continuum, and I think what I'm about to say is right, don't we need to do more on short-term wholesale funding?
Right. Thank you. Oh, that tempts me to a follow-up, which is on the short-term wholesale funding. You've spoken out, I believe, on money market funds and the need for further reform there. Are there other aspects of the funding markets that you would focus on? So
in the short, we at the Fed are already focused on tri-party repo, and I think have been moving forward with a reform program for the major dealer participants there. A good bit has been accomplished, and I think we've picked up the pace a little bit recently. So we'll probably want to step back and say, is this adequate? But Don, in this area, perhaps more than any others, I think one can fairly anticipate that new sources will arise, new sources of funding, once you make one source a little bit less runnable through targeted regulation, which you should do if you've got a big area that's obviously sitting out there and vulnerable. But I think the debate that needs to take place is sort of at a macroprudential level. You know, how do we think about funding, short-term wholesale funding in the financial system as a whole, not regardless of its source, but at least ask that broader question and then focus a little bit on the particular sources.
Great. Thank you. All right, let's open up for some questions from the floor. In the back, yes.
Thank you. I'm Pavel with LaRouche PAC. I wanted to challenge what you said about Glass-Steagall, since I happen to be someone who's, you probably know, campaigning for it. Because one of the arguments for Glass-Steagall is that it would have prevented the mortgage market that collapsed. Because selling a mortgage to an individual is a commercial activity. Selling a financial paper based on the income stream from a mortgage is an investment activity, or some might be able to argue it's an insurance activity. And that whole market under Glass-Steagall would not be allowed to exist, as it used to be the case when you used to have savings and loans banks. Another aspect of that is Glass-Steagall was actually important in reorganizing the financial system under Franklin Roosevelt during the Great Depression, when the banks which were actually bankrupt, like all the banks that took bailouts, are essentially bankrupt. Glass-Steagall was a rule of how to reorganize them. What parts of them get priority when they are going to be repaid? What parts of them don't get protected? That's the importance of Glass-Steagall that has been brought up. The other aspect of it is some of these institutions that you listed as having small involvement in commercial banking, which were investment banks that were failing. It seemed like that the reason why they had any commercial banking activity is to be able to get a bailout, which under Glass-Steagall they wouldn't have been able to do.
Let's let Governor Tarullo respond.
So a couple of I tried not to take my own ultimate position on any of those three proposals. And with respect to Glass-Steagall, what I suggested was that the things that could be lost, the social benefits that could be lost through Glass-Steagall, are non-trivial and thus are on the other side of the balance sheet. But I will say, though, it's not. I have to confess, it's not clear to me how Glass-Steagall would have prevented the subprime crisis insofar as, unless you were going to outlaw securitization, because you could easily have originators who sell mortgages to entities that have no commercial banks, which then package the mortgages through SIVs or other vehicles. So I'm not sure that Glass-Steagall reimposition is responsive to that question. I do understand, as I noted, the sort of extension of the safety net argument, and that's a very real argument, and it's one that's always had something on the policy side to respond to it, whether the Bank Holding Company Act structure, 23A, obviously limitations on bank activities within the commercial bank. But I actually don't think the mortgage piece, or the subprime mortgage, is one part that would be solved by it.
Right. Another question, please. Yes.
Hi, Jennifer Kerslake with Davis Polk. Following up on your recent discussion about regulation of foreign banks, just was curious what, if you could say a little bit more about what you have in mind for U.S. branches of foreign banks. You mentioned liquidity requirements. Just wondering if it would end with that, or if there would be other requirements such as capital or asset pledge requirements.
Well, as I said in this is now the Yale speech. I've been doing the academic rounds this fall. Capped off with Brookings, right?
.edu. Yep.
.edu. That's right, as Leighton always used to tell me. Right. As I said in the speech, there will not be a requirement that the branches, in what I anticipate will be the approach that we'll take, would be under the intermediate holding company. So they would remain an integrated part of the global bank itself. And I think you could fairly infer from the fact that I said existing existing regulations and requirements and examinations would continue to apply, and we would also have a liquidity requirement, albeit one less stringent than for the IHC, that we're not contemplating a de facto subsidiarization and capitalization requirement for the branches themselves. That's sort of part and parcel of the idea that you've got a integrated operation. It's not simply a corporate affiliation, but it's actually part of the affiliation, of the entity, sorry.
Along the back, red tie.
Hi, my name is Aaron Cadell. I work for a firm called Capstone here in Washington, and my question is about Basel III. And the Fed and other banking regulators recently announced that the implementation deadlines for Basel III will be pushed back, and I think European regulators have said similar things recently. There's been criticism of the existing Basel III rules that the capital requirements for large banks aren't high enough. That seems to be consistent with things, with some comparable things that you have said. As you go into the debate over finalizing Basel III, what are you think the key priorities from your perspective? And do you worry that if the implementation rules gets delayed too long, either here or in Europe, that you could kind of lose a window of time and then you could have nothing implemented and basically just have the kind of existing structure with no Basel III that would come about?
So I think one premise of your question is don't let the perfect be the enemy of the good. And I think that clearly clearly something that a lot of regulators and central bankers around the world would subscribe to. Let me say first that the delay here in the U.S., as announced by the three bank regulatory firm agencies, is a function of the many comments that we got. We do seem to elicit a lot of comments on a lot of rulemakings these days, and I suspect a lot of people in this audience are doing a lot of work generating these comments for us. We take quite seriously the concept that's embedded in administrative law that notice and comment is not a formality, that you actually read and think about the stuff that comes in. And I can tell you that in any number of rulemakings, it occasions within the Fed and in the OCC and the FDIC and among the three agencies a lot of discussion. So there was an awful lot that came in, a lot of it on the implications for smaller banks of the changes in the standardized capital requirements, which strictly speaking are not part of Basel III, but because of Collins, because of the fact that we're revamping capital requirements more generally, because of the fact, to be honest, that there was a period in which not a lot of changes were made to the Basel I requirements, despite some views that might be useful. For all of those reasons, these were packaged together because it helped everybody see here's what the shape of capital requirements for all banks will be. I do think that we need to and have been already doing a good bit of cogitation on the implications of this for particularly for the smaller banks. But I don't think there's any question of the continued commitment to the Basel III package. The Basel III package, which essentially has the features of higher capital requirements in numeric terms and higher quality of capital with the focus on common equity in a way that had never been the case before. We had a Financial Stability Board Steering Committee meeting last week, and actually this was one of the topics. It was sort of on the agenda, although I'll tell you it was a pretty long agenda. But this was one of the topics on the agenda, and I said pretty much in there what I just said to you now, and I think what we got from our colleagues in the European Union was a full commitment to move forward expeditiously. But the EU there's a democracy, right? And in a democratic polity, you need to let the Parliament do due consideration. You have other people, just as here in the U.S. We need to have a democratic process around legislating, that means it has to go through our congressional process. So I don't detect any diminution of commitment to the Basel III package. Here in the U.S., it's complicated by the standardized revisions, particularly as they affect the smaller banks. And I think in the EU, it's just complicated by what is always a somewhat complex machinery for things that affect both nations and the EU as a whole.
Yes.
Thanks. I'm Phil Wallach here at Brookings. I'm just curious what you make of arguments made by folks like Jamie Dimon, who say...
I'll tell him you said that.
Who say that the size of their institutions provided a sort of safe harbor during the crisis, and sort of how your industrial organization research agenda that you've discussed could sort of address that role of large institutions.
Well, I mean, I think so here and in other parts of the world, we had some very large institutions that were relatively more stable, and then some very large institutions that were relatively troubled. So I don't think size was very well correlated with how vulnerable the particular firm was relative to others in the industry. I do think, though, that getting back to the agenda, which I hope people here and elsewhere will pursue, but I think this question of whether there is a tendency towards correlation of asset holdings in institutions above a certain size is a very important one, because if that suggestion in a number of papers holds up to further scrutiny, it does tell us that even if a firm is relatively less affected, it is likely to be affected because of the fire sale phenomenon and because of the mark-to-market phenomenon. So you can make points about relative strength, and it was surely the case that some firms weathered it relatively well. But we all know that the system as a whole weathered the crisis only because of extraordinary measures taken by governments in this country and around the world, which, whether or not they were directed at particular firms at particular moments, just change an environment in which there was perceived liquidity and, in many instances, capital support for important firms, thereby placing a floor underneath what was for a while, and this was the case when I came in January 2009 to join Don, a very scary downward spiral.
Yes.
Joe Maria, thank you.
President of the Dan Tarullo fan club. Joe Marie Greasegrabber with New Rules.
Organization.
It's very small. I'm also the newest and last member. Anyway, Dan, I wanted to direct your attention more globally with the issue of bank resolutions. And the FSB did some great work over about a year ago on bank resolutions as they affected the emerging market and developing economies. And yet in the summer of this year, the FSB gave itself basically an F for failure to implement anything related to that resolution, those resolution commitments. And I'm wondering if you could put this situation of international banks and their overflow into developing economies into your research agenda proposed here.
Yeah, absolutely. I mean, I would think, Joe Marie, that the resolution questions more broadly do pertain to the I/O agenda, because obviously structure matters, and that web of relationships as they evolve matter in thinking about feasible resolution of firms. On the international resolution agenda, I think you've fairly characterized some initial work that was done that sort of took, if I can put it this way, some of the low-hanging fruit. But we really do confront some fairly significant hurdles to having a resolution regime that would give fair and consistent assurance to everyone around the world, every counterparty of a bank around the world, that there would be a coordinated, coherent, consistent, and predictable way in which a very large institution would be resolved. Now, why is that? Well, it really springs from the basic fact that we have national systems, and even in the EU at present, national systems for bankruptcy generally, but even for the special insolvency provisions that exist here and in many other countries for bank or financial institution insolvency. That means that the whole package of debtor and creditor rights and priorities that are embedded here and abroad in statutory provisions, vesting, again, here and abroad, an independent judiciary with authority, although we have the FDIC, obviously, with our Dodd-Frank Title II authority, that all of those structures, which are not simply an artifact of banking law, mean that one cannot say with 100% assurance how a given obligation in a given country will be treated at a given moment. And you know, part of what I think is animated our thinking about the international regulation, as I talked about it at Yale last week, has been this notion that banks may operate globally, but they can die locally, and we need to have some assurance that we can handle that should it happen. I think that probably applies as much to developing countries as to developed, although we tend to have much more of the broker-dealer capital market stuff in the United States than a developing country would tend to have, where the run risk is particularly high. So I think it's an area in which we've got every reason to continue to try to make progress, formally and informally, and I think we'll all commit ourselves to continuing to do so, but I think we also have to be honest with ourselves that a seamless global resolution mechanism is not around the corner, which means that we have to ask, we have an obligation to ask ourselves, given institution X and its potential for getting into serious difficulty, do we have a set of policy tools that could at least make that manageable, which could include resolution plans, national resolution schemes. It obviously includes capital and liquidity requirements and the like. So as with almost every other policy, there's not one neat policy response that solves all problems. We're going to have a complementary set of responses, I think, for the foreseeable future.
Although I would add that in the glass 1/8 full category here, I think you pointed out, I know you pointed out at the end of your talk, there's been a lot of work on the single point of entry, and which at least approaches solutions for some of these issues. So I think conceptually, and then it would have to be backed up perhaps by what you said about the debt at the holding company level. So I do think progress has been made in at least thinking through how to do this in a way that I wouldn't have guessed 2 years ago when right after Dodd-Frank was passed and Title II was there and everyone was saying, how are we ever going to use this? I think there's been progress.
So I'll accept the compliment that we've actually done something. I think we have. I just don't want to overpromise.
Yeah.
That's all. And
That's
I think it is the case that the FDIC is moving forward with with a very well thought through, extremely well thought through, impressively well thought through approach to this. But there are still issues. The issues of contracts in other countries, financial contracts in other countries, and the issue of even if a firm has adequate capital at the consolidated level, will that capital find its way into an important national sub? Those sorts of issues are the ones that remain, and they're going to be a little harder to resolve.
Okay. We'll give Martin the last question.
Okay.
Well, I'm a fan of Dan Tarullo, and hopefully a friend of Dan Tarullo, but I'm going to ask a little bit of an argumentative question. The way that some of the new financial regulation being implemented around derivatives, around other aspects, I think going to cause some fairly drastic changes in the industrial structure of the financial sector. That some institutions, large and small, will have to scale back some of the things they do, maybe get out of certain lines of business. And that has raised the question that I think has been raised to you. Well, who's going to provide those services? Isn't that going to be disruptive to the economy? And I think the answer back from the Fed or other regulators, well, don't worry about it. Other people will come in and provide those services. So my sense is there's a hypothesis here that the industrial structure of this industry is pretty fluid, and that if one firm can't provide the services, that the expertise will find a place elsewhere, and fairly quickly you'll be able to continue to have the same flow of services to the end-use customers. So I wonder, do you agree, disagree with that? Could you comment on to what extent you guys have thought about how, over what pace, what time period you think the industry can adjust to some of the rules that are coming down the pipe?
So can I ask you first, Mark? Don't give the mic away yet. So when you said some of the regulations that are being implemented, it sounded as though you had, margining in mind and
counterparty credit limits, the Volcker rule, so the stuff around derivatives certainly.
So I think, I mean, to some degree, so there are several answers to the question. One is, what's the starting point for the analysis? Are we saying, gee, there's some regulation going in which would prevent the structure and nature of activities circa 2006? I think that's absolutely right. And to the degree that there was some economic activity in that period which was associated with highly runnable funding and with poorly underwritten mortgages and other lending products, I would say I think that kind of economic activity is a little bit illusory, right? Because the apparent benefits of it in the short term turn out to carry costs. So I guess that first point is the obvious one, that the fact that a particular regulatory approach would inhibit a particular kind of activity doesn't mean it's the wrong thing to do. That's number one. Number two, for the reasons I stated in my response to Dawn's opening question, I think it's a little hard to pull apart what's motivating in these different areas. I mean, I think that, here's an example. I don't think there's any question but that levels of lending, traditional bank lending in a lot of areas, are lower than they would otherwise be because of a economy which is still not recovered from the Great Recession and the like. Is regulation playing some role there? Yeah, I mean, I think certainly on mortgages, for example, mortgage servicing requirements and the like, there'd be some role. But again, it's intended to be directed towards problems that existed beforehand. The question, I guess, about I think in a way you're asking a question about cumulative costs. So if you're going to have margining requirements and derivatives push out and Volcker, all of which, by the way, are required by statute. So this is not, it is something we're under a legal obligation to do. But if you're going to have all these things, how do they interact with one another? And that is a harder question to answer because you don't have obvious precedents to go back and look at. It's for that reason that we've suggested that the industry itself is best positioned to give comments on just that question. And to say, here are the particular ways in which the combination of these requirements will affect what we do, and of course the implication. But then they sort of have to draw the next point, which is not that it will, simply affect our profitability, but they have to kind of make the point about social benefit. And I think that there hasn't been as much of that, certainly not as much useful of that kind of commentary as I think some people anticipated that there would be. So if you're looking at things from our vantage point, we think about particular regulations. We try to think about them in particularly things like liquidity. We definitely try to think about it in a broader context. We do an assessment of costs and benefits, but that, particularly on the cost and negative side, I think we're necessarily gonna be expecting that those who think they would be most affected would provide convincing analyses along those lines. On the other hand, it may be that some of this stuff needs to be done at a more elevated or higher level, and maybe that's another part of the Brookings agenda. I think it's going to be hard to quantify a lot of that. I don't know if you disagree, but I think it's going to be hard to quantify a lot of it. Yeah.
Great. All right. Thank you very much, Dan.
Thank you.